Yeah, welcome back. Right. So the other thing that we talk about when we're looking at gross income definition, of course, is specific inclusions. So what are the amounts that are specifically included to be part of gross income? Again, a long list. I'm not going to go into that, but just to highlight a couple of things. So if you look at the different paragraphs, because remember, the gross income definition then has different paragraphs, so paragraph A, paragraph B, and so forth. If you look at something like fringe benefits, fringe benefits are included in terms of paragraph N of the gross income definition. Okay, so if a person does receive a fringe benefit, that fringe benefit ultimately rolls up into the gross income through paragraph N of the gross income definition. Okay, so if you do receive, for example, a lump sum from a fund, that would be a specific inclusion in terms of paragraph E of the gross income definition. So the paragraphs specifically look at transactions and they deal with those specific transactions. So it's important that you look and have an understanding of those specific transactions. I think one of the other transactions I just want to touch on, of course, is Section 9 capital C. Now, Section 9 capital C specifically deals with shares. And what does Section 9 cap C says? It says that if you buy shares and you hold on to them for a period of at least 3 years. So you buy shares and you hold on to them for a period of at least 3 years, then those shares are deemed to be capital in nature. So as soon as you hit more than 3 years, those shares are capital in nature. Even if you are a share dealer, remember, share dealers buy and sell shares for a profit, and for them, those shares constitute inventory. So it says that even if you are a share dealer, Section 9 capital C says more than 3 years that you've been holding on to a particular share, and therefore that share is now treated as being capital in nature. And if you then dispose of that share after the 3-year period, then there will then be capital gains tax implications from the sale of that share. Okay. Now, the other thing to then consider is that when a person acquires shares, let's say I'm a share dealer, when I acquire these shares as a share dealer, I would have acquired trading stock, and the expenditure that I would have incurred would have been allowed as a deduction in terms of Section 22 of the Income Tax Act. Okay, you acquire something, you incur an expense, and that expense is then allowed as a deduction in terms of Section 11A, all right, and then it's then accounted for in line with Section 22. Now, what then happens is that, think about it, CGT is at a lower rate than normal tax, which means as a taxpayer, I would want to be taxed at the CGT rate and not at the normal tax rate. Now, it's, of course, in order for me to reduce my tax liability, I will always want to argue that everything that I have is capital in nature and therefore pay tax at the CGT rate. Okay. Now, the legislation then looks at that and says, okay, fine. In an instance where you've been allowed a deduction under Section 11A or under Section 22, and now Section 9 cap C is then kicking in and saying you are now going to be taxed using CGT, the CGT rate on the sale of these shares, which means you're now going to be taxed at a lower rate. Then what the legislation then says that the deduction that has been claimed must now be recouped. So remember, a person, when they bought the shares, they would have either claimed, a Section 11A deduction, or if they've been holding on to these shares for a period exceeding 3 years, of course, they would have been claiming the opening stock deduction claim. So what this is saying is that you've made a claim, or you've claimed a deduction, and because you've claimed a deduction, that deduction that has been claimed must be clawed back. So we call it a clawback in terms of section 9 cap C subsection 5. Okay, so there must be a clawback of that deduction, because remember, now that the shares are being classified as capital in nature, the cost that you've incurred to acquire those shares will be the base cost now for CGT purposes. So then you can't end up having a double deduction where you get a section 11A deduction and that cost is also classified as a base cost, because that effectively constitutes a double deduction. So that is why that cost that you had previously claimed under section 11A, or you had previously claimed as a deduction as part of your opening stock, must be clawed back in terms of section 9 cap C subsection 5. So a clawback is similar to a recoupment. Okay, so that cost will then be included as part of the taxpayer's income. And for shares, you're going to use the clawback in terms of section 9 cap C5 instead of section 22 subsection 8. Now, if we take a step back, no, let's not get into that. It's not for this session. Okay, all that's important is that your clawback is going to be in terms of section 9 cap C subsection 5. When shares are disposed of, the FIFO method is the valuation method that is applied. So first in, first out would be the method that you'd apply. So if you bought these shares in different batches, then you would apply the FIFO method. And remember though, in an instance where you cannot make a distinction between your shares, okay, so in an instance where it's not possible to use the FIFO method, then you are then allowed to use the weighted average method. Okay, but in an instance where it is not possible to use the FIFO method, but the FIFO method is the preferred method for the disposal of shares in terms of section 9 cap C subsection 6. Okay, right. So I'm not going to go into special inclusions. I'm just cognizant of the time, and I want us to then make the jump and go to VAT.
Sorry, Mr. Mpetra, may you please share your slides? I'm not sure whether I'm the only one who...
You should have access to these slides because they're sent out to you guys as part of the, what do you call it? As part of your pack?
The slides were not uploaded yet for text this morning.
Okay.
I think they mean share your screen, isn't it? If you share.
Am I not sharing my screen?
No, you're not.
You're not.
Oh, okay, sorry. I thought I'm sharing my screen. I thought I am sharing my screen. My apologies. My apologies. Sorry, I thought I was sharing my screen. Okay. All right, because we've got these two, I'm gonna call them two massive sections that we need to go through. That's why I'm now jumping from gross income and coming to this side. All right. Now let's look at VAT. So VAT is a separate piece of legislation from the Income Tax Act, and it governs how value-added tax is accounted for, okay, by a person who's a vendor. So the important thing is that you need to be a vendor, okay, in order for you to be required to account for VAT, meaning that once you are a vendor, you'll then be able to claim input Whereas all of us, if you are transacting in South Africa, and you are transacting with somebody that is a VAT vendor, there is value-added tax that we pay. So that's why it's quite interesting in South Africa that a lot of people tend to say it's only a few people that are paying taxes in this country, and people tend to forget that all of us, regardless of who you are, we are paying VAT. So so we can't then say there are a few people that are paying taxes in this country, because all of us are paying VAT. Yeah. So in looking at the VAT Act, I think it's important that we'll talk about when is VAT imposed, looking at things like taxable and non-taxable supplies, how do you claim your VAT input, and then there are then specific circumstances or specific transactions that are then dealt with under the VAT Act that don't follow the normal convention, if I can call it that, the normal convention of the VAT Act. Now, maybe before I jump into some details in the VAT Act, I want to set the scene. So I'd like to set the scene in terms of when you are looking at VAT, what are the things that you need to consider? And what do I mean by that? Sorry, I just want to quickly look for something that I can share with you. Okay, I'm not seeing it. Okay, it's fine. Okay, so when we're looking at VAT, and I just want to paint the big picture, and it goes back to one of the things that somebody asked me to talk about from the expectations. So when you are looking at VAT, the important things is let's start off with output. So when you're looking at VAT, and the important things that we need to think of when you're looking at the VAT legislation is that we first need to talk about output. Now, output, where does everything start? So here I want to do a high level, very high level picture of what does the VAT legislation look like? Because if we do that, you will then be able to navigate the VAT Act, and you'll be able to think, what are the things that I need to think of when I'm looking at the VAT Act? Okay, so now we're looking at the output. Now, when you're looking at the output, your starting point, and this is really steps that I'm putting down here, your starting point is Section 7. Okay. Your starting point when you're looking at the VAT Act is for you to go to Section 7. Now, why is it important that you go to Section 7? Because of the following reasons. So I'm opening my legislation, and I'm opening my legislation in Section 7 of the VAT Act. Okay, so the other thing I want to achieve with this is that I hope you do have your legislation with you, because we are going to read the legislation. Okay, because one of the things that was communicated to me earlier on in the morning was about, can I help with the reading of the legislation and the interpretation thereof? Okay, and the other thing I would say is the only way, and I mean the only way, there's no shortcut to this one. The only way you're going to learn how to read the legislation and for you to become comfortable with the legislation is for you to read the legislation. Unfortunately, in order for you to get rid of the pain, you have to enjoy the pain. It's one of those things. And the more you enjoy the pain, the less painful it becomes. Yeah, quite an example I'm using, but yeah, that's unfortunately how it works with the legislation. You need to read it over and over and over so that you become comfortable with the language that is contained in the legislation. You need to become comfortable with how it is written and how it works. Okay. So I'm going to read Section 7. because the imposition of VAT is driven by Section 7 of the VAT Act. So Section 7 is titled Imposition of Value-Added Tax. Okay, so then it then says subject to the exemptions, exceptions, deductions, and adjustments provided for in this Act. So let me stop there. So what that means, so whenever it says subject to, it means that in you considering what is contained in Section 7, you also need to take into consideration that there might be exemptions, exceptions, deductions, and adjustments that the legislation provides that will then supersede what Section 7 says. So as an example, if we look at Section, if we look at something like Section 12, which is exempt supplies. Okay, so as you can see, it says subject to the exemptions. So which means then the application of Section 12, which says the following are exempt supplies, will supersede the application of Section 7. So the application of Section 12 will supersede the application of Section 7, because when Section 7 starts off, it says subject to the exemptions. So Section 7 can only be taken into consideration if none of the exemptions are applicable. That's what it's saying. Okay, so that then means when you're applying Section 7, you need to know what exemptions are contained in the VAT Act in order for you to ensure that you take those into consideration before you apply Section 7. Okay, so if you then continue reading Section 7, so we say subject to the exemptions, exceptions, deductions, and adjustments provided for in this Act, they shall be levied and paid for the benefit of the National Revenue Fund a tax to be known as value-added tax. So it's saying that there's a tax that should be paid, and that tax is known as the VAT tax, as the value-added tax. And what's that tax paid on? Okay, A then says on the supply by any vendor of goods or services supplied by him on or after the commencement date in the course or furtherance of any enterprise carried on by him. Okay, I'm going to read that again. On the supply by any vendor of goods or services supplied by him on or after the commencement date in the course or furtherance of any enterprise carried on by him. Now, let's then look and try and break that down so that we've got a better understanding of what it means. One, it says that VAT will be imposed on the supply. So for me, I would underline supply. That supply is made by any vendor. I would underline vendor. And that vendor is supplying goods or services. And those goods or services are supplied in the course or furtherance of any enterprise. For me, I would underline enterprise. Okay. Now, why do I underline those three words? Because those three words are three words that are defined in the legislation. So if you go to Section 1 of the VAT Act, you will see the term supply is defined there in the legislation. Okay, so the term supply is defined in the legislation. And if you look at Section 1, supply, it says, supply includes performance in terms of a sale, rental agreement, installment credit agreement, and all other forms of supply, whether voluntary, compulsory, or by operation of law, irrespective of where the supply is effected, and any derivative of supply shall be construed accordingly. So in simple terms, those things that are specifically included, so a sale, a rental agreement, installment credit agreement, and all other forms of supply. Okay, so that would then be a supply. as you can see, that supply definition is quite wide again. Okay, it's a wide definition. And therefore, when you're looking at your scenario, you need to look at that scenario and say, does this scenario fit into this definition? Okay, so does the scenario fit into the definition? So your first point is then section 7, imposition of that. But the other thing we've looked at supply. Then I then said the other word that we need to underline is vendor. And the last one that we need to look at is enterprise. Okay, so that's point number 2. Okay, so do we have a supply? Is it by a registered vendor? And is it in the furtherance of an enterprise? Okay, let's then have a look at the definition of a vendor. Okay, so a vendor means any person who is or is required to be registered under this Act, provided that whether the commissioner is under Section 23 or Section 50 Cap A determine the date from which a person is a vendor, that person shall be deemed to be a vendor from that date. Okay, so according to the definition, you need to be registered. So either you are registered, or if you meet the threshold and you are required to be registered. Yeah, and I think that's the important thing, because it says it means any person who is, meaning that you are already registered, or if you meet the requirements for registration, then you are classified as a vendor, even though you have not yet registered. So as soon as you meet the requirements to be classified as a vendor, then you are deemed to be a vendor for tax purposes, even though you might not transact or conduct yourself as if you are a VAT vendor. But as soon as you meet the requirements, you are then a VAT vendor in terms of the legislation. Okay. So those are the 3 things. So Section 7 says you must impose VAT, but who must impose VAT? That VAT must be imposed on a supply that is made by a vendor in the furtherance of an enterprise. Now then, if we then look at the definition of enterprise in Section 1, okay, so if you page over to the enterprise definition, enterprise says, enterprise means in the case of any vendor, so 1, you can only have an enterprise if you are a VAT vendor. So that's why it's important that you deal with some of these things. So in the case of any vendor, any enterprise or activity which is carried on continuously or regularly by any person in the Republic or part in the Republic, and in the course or furtherance of which goods or services are supplied to any other person for a consideration, whether or not for profit, including any enterprise or activity any enterprise activity carried on in the form of a commercial, financial, industrial, mining, farming, fishing, municipal, or professional concern, or any other concern of a continuing nature, or in the form of an association or club. Okay, that's just the general definition. So as you can see, the definition of an enterprise is very wide, because it says that it's any enterprise or any activity. Okay, so that means absolutely anything under the sun could be an enterprise. But in order to provide more details over and above just saying any activity, so that activity must be carried on continuously. So you cannot do something once off and then say that's an enterprise. It needs to be carried on continuously, and it must be carried on in the Republic. The reason why they make it very important that that activity must be carried on in the Republic, it's because, number 1, VAT is driven by consumption. So VAT is a piece of legislation that is driven by consumption. So it's important for us to determine where does that consumption take place. In order for VAT to be imposed, the consumption must take place in South Africa. Okay, so it's a consumption tax. So we then say, where does that consumption take place? Okay, and if that consumption takes place within the Republic, then we then say, okay, fine, VAT will then be imposed on that activity because it's an activity that took place in South Africa. Okay, I'll stop there for now. Any questions? Okay, I'll take the silence as no question. All right, so now that we are happy that there's a supply, there's a vendor, there's an enterprise, the legislation says to us we must impose VAT at a rate of 15%. Of course, that is given to us by Section 7. Section 7 says to us, impose VAT at a rate of 7%, not 7%, 15%. Okay, so that rate is imposed at a rate of 15%. Okay, so we've got a supply, we're imposing VAT. So then the next thing is to then say, okay, fine. Remember the one thing I emphasized earlier on was that tax is about looking at specific periods. So if you're looking at the month of June, we need to say what transactions took place in the month of June. And therefore, we're only going to consider the transactions that took place in the month of June. Similarly to the VAT Act, it does exactly that, where you then say, when did the transaction take place? Okay, so then for me, the next thing is looking at the timing of the transaction. So it's looking at the timing of the transaction, which is then Section 9 of the Act, whereas here we're looking at Section 1 of the VAT Act, and here it's Section 7 of the VAT Act. Yeah, so the timing of the transaction, it's us looking and saying, when did the transaction take place? Because remember, the important thing about VAT in looking at the timing of the transaction, what you also need to consider is that the general rule for the timing of a transaction says that it's the earlier of invoice or payment. Okay, you've got a VAT transaction that is then subjected to being the earlier of payment or invoice. Okay, that's what generally triggers VAT. As soon as you invoice or as soon as there is payment, then VAT is triggered. I know maybe with other things, with other disciplines, you'd look and say, when did the risk and rewards pass? Okay, but for VAT purposes, what drives it is, as I said, it gets triggered by the earlier of payment or invoice. Okay. However, over and above just looking at the general requirement when it comes to the timing of a transaction, which is the earlier of payment or invoice, you need to also look at specific transactions. So there are specific transactions that are dealt with under Section 9, talking to the timing. Now, these transactions are specifically included there because they deal with certain things. So as an example, so if you read Section 9, subsection 1, so that gives us the generic, okay, because it says for the purposes of this act, a supply of goods or services shall, except as otherwise provided in this act. Okay, so it's saying, except if there's anything in this act that is contrary to what I'm proposing. So it says, for the purposes of this act, a supply of goods or services shall be deemed to take place at the time an invoice is issued by the supplier or the recipient in respect of that supply, or the time any payment of consideration is received by the supplier in respect of that supply, whichever time is earlier. Okay, so when we're saying the earlier of payment or invoice, it's not that we are trying to be funny, it's what the legislation says, which is what I've just read now. Okay, so that's the general, what can I call it? The general provision relating to payment. So it's not payment, relating to a supply. Okay.
Am I right to say when they say earlier of payment or invoice? So if you do not elect to be accounting for your taxes using the payment basis and you're using the invoice basis. So if you receive the money, if you receive the payment, obviously we would look at the time of supply will be payment if it was received earlier. Is it what they're saying?
So you are saying I am on the invoice basis?
No, yes, you elect. No, you do not elect. You automatically, generally on the invoice basis. No, the general rule is that it's an earlier of payment or invoice, isn't it?
Yes.
And then if you elect payment basis, and then you elected payment basis, however, the invoice came first. So you are not obliged to pay tax on the invoice, on the invoice basis because you chose payment, isn't it?
That is correct. So if you're on the payment basis, then yes, you're not liable for that VAT until payment has been received.
Okay.
Yeah. Now, I wanted to expand further on that in terms of what does payment constitute? As you can see, it talks about any part of the payment, does not say the full payment must be made. So it's the area of payment or invoice. However, even the payment, it does not say so much of the payment. It simply says as long as there's a payment of the consideration, then it is subject to VAT. Okay, so that's why it's then important when we are looking at the timing of a transaction, because it talks to payment of a consideration. Now, again, consideration is a term that is defined in section 1. So remember, when you come across any term that is defined in the legislation, you have to go back to that definition in order for you to then become comfortable to then say what is classified as consideration. Okay, so what is then consideration? And I go to section 1 of the VAT Act. Okay, so when I look at section 1 of the VAT Act and I'm looking at consideration, let's see. Okay, so consideration, it then says in relation to the supply of goods or services to any person, includes any payment made or to be made, whether in money or otherwise, or any act of forbearance, whether or not voluntary, in response to, or for the inducement of the supply of any goods or services, whether by that person or by any other person, but does not include any payment made by any person as a donation to any association not for gain, provided that a deposit other than deposit on a returnable container, whether refundable or not, given in respect of a supply of goods or services, shall not be considered as payment made for the supply unless and until the supplier applies the deposit as consideration for the supply or such deposit is forfeited. Okay, so as you can see, the consideration definition is quite long. And again, the important thing there, it says that consideration can be in cash or otherwise. Yeah, so the consideration can be in cash or otherwise. So now when you're talking about the timing of the transaction, and we are saying it's the area of payment or invoice, when you're looking at payment, you need to consider that that amount which we've received, was that amount, what can I call it? Was that amount, or has that amount been applied as consideration? Okay, it's what we need to look at and determine.
Okay, so what you mean is if you're gonna be using an invoice basis, obviously it's gonna be area of invoice or payment. And then let's say there's an invoice amount, obviously automatically there, you're gonna be leaving output tax on the full invoice amount, right? And then if it's payment basis, and then we're only going to be leaving output tax or output VAT when there's a payment. So what happens is, what if you receive payments on portions? So if you receive a portion just because of consideration is saying any payment, doesn't mean now that on a portion of the payment that was received, we can levy output tax at that time, and then when we receive maybe let's say the rest of the money or another portion, we can levy output tax like that. Is that what you mean?
Nope. What I mean is, let's say a person pays you 40% of the consideration for a supply of goods or services. You, as the VAT vendor, you'll have to account for 100% of the VAT for those services because you have now received a portion of the consideration.
Oh, okay.
And you do not account for that to the extent of the money received. No, you account on the full supply of goods or services that you've done.
Oh, it also caters the idea that you cannot apportion output VAT.
Yeah.
Okay, perfect. Thank you.
Thank you. Okay. All right. So we talk timing of transaction, but the other thing I want to emphasize with you guys, you need to go into Section 9 of the VAT Act because certain transactions are then dealt with separately. Okay. Because, for example, if we look at let me just see a quick example. I'm trying to find one that will be slightly easier. Okay, so let's look at, for example, if we look at Section 9, subsection 2B. So Section 9, subsection 2B. Remember here we're looking at the timing of a transaction. So here it says a supply of goods or services. So sorry, here's something as just as a tip when you are reading the legislation. So here I said I wanted to read Section 9, subsection 2B. Okay, so I need to start at Section 9, subsection 2, and then go to B because there's something that comes before we get to B. Okay, so what's that thing that comes before? It says that a supply of goods or services shall be deemed to take place. So Section 9(2) says a supply has taken place, and then B then gives us a specific transaction of where would that supply take place. So it says that a supply of goods or services shall be deemed to take place where that supply, so I'm now reading B, where that supply is a supply to which Section 8, subsection 3, sorry, no, man, I didn't want to, I wanted to read C, where that supply is a supply to which Section 8, subsection 4 refers at the time at which the goods or services are delivered to the recipient. Okay, provided that in any case in which a supply of services is deemed to take place under Section 8, subsection 4B, the supply of services shall be deemed to take place at the time that the agreement of sale is cancelled or terminates. Now, if you were to read that in isolation, you would say, what is this saying? Okay. Now, first things first is that in Section 9(2)(c), there's one thing they're referring to. It's an individual spot. Sorry. So there we are saying section 8 subsection 4 is talking about there is a lay-by that has been made. Okay, so section 8 subsection 4, it says that, so if I read there, it says, for the purposes of this act, any lay-by agreement as defined in the government notice, whereby goods are sold for a consideration not exceeding 10,000 rands and are reserved by deposit for delivery when the purchase price or a determined portion thereof is paid, shall not be deemed to be a supply of goods or services unless and until the goods are delivered to the purchaser. So now think of the normal rules of timing. The normal rules of timing say it's the area of payment or invoice. In an instance where you lay buying goods, you pay a deposit upfront, and then you then come back again upfront before receiving the goods. You come and you pay for the goods. You are given a certain period of time. So what this is then saying is that if there is a lay-by transaction of less than 10,000 rands, then the normal timing of transaction rules will not be applicable in that instance. Okay, because now if we then look at section 9(2)(c), it says that there will not be a supply at the time. So it says that where that supply is a supply to which section 8 subsection 4 refers, at the time at which the goods are delivered to the recipient. So here we're not talking the area of payment or receipt. Here we're talking about delivery of goods. So the transaction will be deemed to have taken place when the goods are delivered. Okay, so when we are looking at the timing rules, it's important that we do not just end at section 9 subsection 1. We need to link to go on further, and you'll see that under section 9 subsection 2, it links back to other things. So as an example, the one thing that stresses a lot of people when it comes to timing of transactions and other things. Sorry, let's just drop my glasses. Yeah, so what stresses a lot of people, it's because they don't take the time to read what is contained in the legislation. And because they don't take the time to read what is contained in the legislation, what then tends to happen is that people then get confused and say, no, but I don't know where to find this. How do I deal with this type of transaction? The legislation is very simple, guys. It sets out transactions that you need to deal with. Okay, so if, for example, we were to look at section 9(2)(d), so section 9(2)(d) says that where the supply is for a consideration in money received by the supplier by means of any machine, meter, or other device operated by a coin, paper currency, token, or by any other means. So I'm going to stop there. What does that mean? It means if I am a vendor and I run vending machines. Remember, vending machines are those machines where I load the goods, and you simply come, you put your money in there, and then you press whatever, you put the code for the goods that you want, and then it then calculates, okay, you've put in enough money, and then it gives you a Coke. So for example, I could have a vending machine for Coke, I could have a vending machine for chocolates and so forth. Okay, so section 9(2)(d) then says if you have vending machines, what is the timing of the transaction? So again, it's no longer looking at the area of payment or invoice, but it's got specific timing rules when it comes to somebody running a vending machine. So there it then says where the supply is for a consideration in money received by the supplier by means of any machine, any meter, or other device operated by a coin, paper currency, token, or by any other means. It then says, in the case of such supplier, at the time any such coin, paper currency, or token is taken from that machine, meter, or other device by or on behalf of the supplier, or an amount is received by the supplier by any other means. Okay, so let's say I've got a Coke vending machine, and I then say to myself, I'm only going to go to refill that Coke machine and take the money after 6 months. Because this thing says, at the time any such coin, paper currency, or token is taken from that machine. It's not saying when the money is available at the machine, it's when it's taken. So what I could simply do, if I want to postpone the payment of VAT for as long as possible, I could simply leave the money that is sitting in the vending machine. And all I'm going to do, I'm just going to go there, refill the vending machine, and leave the money. Then in that way, I don't have a supply has not taken place because I'm leaving the money. Yes, I am selling my stock, but I am leaving the money in the vending machine because I'm saying the supply rules say that it's only when you take the money from the machine that a supply has taken place. Okay, so can you see section 9 has got specific transactions that it deals with. And if you've not read section 9 and you come into the test and you read a scenario, and that scenario happens to be one of these sections that are contained in section 9 subsection 2, then unfortunately what's going to happen, you are not going to know that you are required to apply, for example, section 9 subsection 2D. All you're going to do, you're going to say, okay, this is a vet vendor. They sold Coke through a vending machine, and therefore it's the earlier of payment or invoice, which would not be correct.
Well, so I think SARS should revise that. Should be giving you guys 3 months or something for storing the Coke or whatever in the vending machine.
Look, if this, for me, this makes sense in a sense that if you think of Matodonke, who happens to have one vending machine, yeah, it does look like, okay, Matodonke is gonna go and take those coins whenever he wants to take those coins, in order for him to manipulate his VAT. However, there's probably a bigger business consideration here, in a sense that if I've got this vending machine, chances are, one, it has got limited storage in terms of the money that goes into it. So that means I can't sit for a year and not collect that money. At some point, it's going to stop working because there's not enough space to store money. Number two, I don't think when you are considering whether to take the money from the vending machine or not, the only thing you're going to consider VAT. Why do I say that? The reason why I say that, it's because you're running a business. If you need to refill, you need to restock that vending machine. And in order for you to restock that vending machine, you need cash. And so you're going to take the cash that is sitting in the vending machine and you're going to use that to go and buy more stock in order for you to restock the vending machine. Okay, so there are considerations over and above just the VAT that you need to think about. Hence, when I look at a section like this, I don't think, yes, it can be manipulated by a VAT vendor. It's just that the reality of it is that manipulation will be to a limited extent. Okay, Bernice, your hand is up. Please go for it.
I see you're talking about the vouchers under, under section, what's this, 2D? I only said 1D. 2D, right?
Yes,
but I said it's excluded from the framework. Maybe am I misunderstanding something?
From your examiner pronouncements?
Yes.
Yeah,
no,
no,
supposed to know it.
It's excluded from examiner pronouncements, but the point I'm trying to make around these things was to look at the timing of supply for different things, to then say, what do you call this? Over and above the earlier of payment or invoice, there are other specific transactions that are dealt with under section 9 that look at the timing, and they look at the timing different to how section 9 subsection 1 looks at the timing.
Oh, I was a bit confused that time because I was trying to highlight, but I was like, I excluded it.
Yeah, no, it was just to illustrate the point around the timing of transactions.
All right, no, thank you very much.
All right, thank you. Okay. for example, if I pick up another example, and I hope this is the one I'm going to pick up, is not, it is in the, examiner pronouncements. Okay, not that one. Okay, so let's look at, and I know this is something that's very specific and it gets a whole lot of people confused. If we then look at section 9, remember we're still talking about timing. So if we look at section 9, subsection 3D. So section 9, subsection 3D. So if you look at, start reading off at 3 before you jump to D, it says that notwithstanding anything in subsection 1 or 2 of this section, right? So what effectively it's saying is notwithstanding what is contained in the other ones. So can you see here, it's not saying subject to, because remember when I said earlier on that when it says subject to, it means the other things supersede what is contained in that section where it starts off by saying subject to. Whereas here it's saying notwithstanding anything else that's contained somewhere else. So there might be something that is contradictory to what we're about to read that's contained in section 9. But it's saying that notwithstanding that you've read somewhere else in section 9, this is what section 3 says, and you must apply what section 3 says. Okay, because it's saying notwithstanding anything else that is to the contrary of what you're about to read. Okay, so that's different to subject to, because subject to tells us that that thing supersedes that particular section that you're about to read, where that subject to is included. Whereas if you are looking at something that says notwithstanding anything in subsection 1 or 2, so there we are saying notwithstanding anything that might be contradictory to what we're about to read, we will continue to apply what is included in subsection 3. Okay, let's then read subsection 3D. Subsection 3D says, where goods consisting of fixed property or any real right therein are supplied under a sale, that supply shall be deemed to take place where registration of transfer of the goods is effected in a deeds registry on the date of such registration, or on the date on which any payment is made in respect of the consideration for such supply, whichever date is earlier. Okay, can somebody tell me what that refers to? So section 9, subsection 3D.
I think when you're buying a fixed property, isn't it?
Yeah, so it's when you're acquiring a fixed property. And so what then does section 9 3D then say when you're acquiring a property? What's the timing of that transaction?
So whichever is earlier, the registration day or when you are making payment.
Okay, so it's the earlier of registration or payment. So again, general provision that says the earlier of invoice or payment. This time we look and we say it's an acquisition of a fixed property, and therefore it's the earlier of registration or payment of consideration. Again, any part payment of a consideration equates to the payment of a consideration. Okay, so any part payment of a consideration equates to the payment of a consideration. Because the other thing that you're then going to ask me is, no, but sir, when I read my notes on the supply of a fixed property, it says that the timing, of course, is the earlier of registration or payment. However, if I only make a payment of a certain portion of the amount, therefore I can't claim. I need to account for that to the extent of the payment. Now that which then talks to the extent of the payment, it's not the timing of the transaction, but it's the value of the transaction. Okay, which then takes me to my next point, which is then point number 4. There, we're looking at the value of the transaction. and the value of that transaction will then be dealt with under section 10. Okay, so section 9 talks to timing of these transactions. Then section 10 then talks to the value of the transaction. Now, if we look at section 10 and look
before you move to the value, so for like exam purposes, like when we have to be discussing the timing of a supply, do we maybe have to speak about how normally or generally we're looking at the earlier receipt or payment, and then afterwards discuss the specific section, or we just have to look at that specific section?
Okay, so I would say if it's a specific transaction that is given to you, then there's no need for you to discuss the earlier of payment or invoice. Let's say it's a sale of a fixed property. I would say do not discuss the earlier of payment or invoice. I would suggest that you go straight into section 9, subsection 3D, where you are specifically dealing with the timing rules of the sale of a fixed property.
Okay.
Okay. But again, the other thing that would drive that is one, the scenario that's given to you, the extent of the information that is provided to you. Two, it's the mark allocation. So if you get a discussion question, let's say for 20 marks, and again, looking at the scenario, if there aren't a lot of gray areas that you need to discuss, then what I would then suggest is that you first discuss the general principle, and then after discussing the general principle, then go to the specific provision. Okay. However, that there are a number of different determinants that would guide you in terms of what is it that you need to discuss and to what extent you need to discuss those things.
Okay.
All right. Thanks. Okay. Any other questions, guys, from the timing before we then move on to the value of a supply? Go ahead, Bernice.
There is one section under the time of supply which I got confused with and I need help with. It's subsection 4B.
Yes, subsection 4B, okay.
Yes, where it talks about when a consideration for such services are not yet determined. So I cannot really envision or see how is that possible, or I don't understand the concept of it.
All right, so it says, so I'm going to read 4, then I'm going to jump to B. So subject to the provisions of subsection 2A or 6. So again, look at 4. 4 is saying that subject to something else, meaning that something else is applicable, and therefore this section is subjected to that other section. So that means those other sections, meaning that subsection 2A or 6 supersede what is applicable under subsection 4. Okay, so just note that, all right?
Okay.
Unlike, for example, when we're looking at subsection 3, where it says notwithstanding. Okay, so it's just to, again, illustrate the differences that you'd see in the different sections. Okay, so let's then look at interpretation of section 4. So subject to the provisions of subsection 2A and 6, where services are supplied under an agreement, and the consideration for such service supplied is not determined at the time that such services are rendered or performed, that supply shall be deemed to take place when and to the extent that any payment in terms of the agreement is due or is received, or an invoice relating to the supply is issued by the supplier or the recipient, whichever is the earliest. Okay, so you are then saying you cannot see when such a situation would take place. Hey, Bernice?
Yes, no, I muted my mic so I didn't want to disturb you. Yes, like the thing is that now I'm looking at, to be honest, I took lightly the part subject to provision, which you just highlighted now.
Yes.
And also now see the conjunction whereby it says A about installment credit agreement or rental, and then there's B also, which are asked to explain about. So I thought personally when I read it, I misunderstood it that there is a possibility that you will not get. There's a service that is rendered, but they will not tell you the amount on that time.
Yeah, so in actual fact, you're correct. So what you'll find is, let's say there's a service that is rendered, but we cannot determine the value of that service at a point in time. Then what this is saying is that, okay, fine, if you cannot determine the value of the service at that point in time, then the transaction has not taken place at that point in time. Okay. However,
Yes.
maybe what might happen is that there might be a portion of the consideration that is paid. Then what you'll then do, you then account for that to the extent of that portion of the consideration that was paid. Or maybe they've invoiced something. Then again, you will then account for that to the extent of whatever they've invoiced, even though we've not determined the full value of the service that was provided.
Oh. So with B, it will be effective only if also subsection 4A is also met, because I also see and.
No, so A is looking at where goods are supplied, where B is looking at where services are applied.
Okay.
Are supplied.
Let me highlight that part.
Okay.
Oh, now
So
I
A is
see it.
looking at goods, whereas B is looking at services.
Oh, now I see the difference.
Yeah.
Okay, no, thank you very much.
Thank you. So Amukelang, you've got your hand up?
Yes, sir. Just on what Bernice was saying, on B, subsection 4B, where it says to the extent. So does it mean that it's different now to what we were doing to say that any payment has been made, like in terms of what should be levied output tax on?
Yes.
Like, okay.
Yeah. So because here it specifically says to the extent.
Okay.
Yeah. So then you'd account for output to the extent of the payment. Because remember, there are services that have been provided. We cannot determine what's the full value of the services. However, maybe there's an extent of payment that has been made.
Okay.
Yeah.
Before we move on, sorry, it's another question I got stuck with. There is a part whereby it's at subsection 3, right? You were talking throughout the times, you're talking about payments. And then when they talk about payment, you said that they didn't say if it's full or half. So as long as payment has been made.
Yes, as long as there's a payment of the consideration that has been made. So let's say you make a supply of 100 million.
Yes.
And somebody pays you R1 of that 100 million. Payment has been made.
And then the tricky part came along, because I read also, and I was just looking for it, where they spoke about installments. How is that different from payment has been made? Because I was looking at subsection 3B, when installments is made periodically. So I was like, okay, you spoke about payment, because to be honest, when I read this, the VAT, I thought, okay, payment has to be full because I saw the installment part.
Okay, no, so payment, any part payment of consideration equals to payment. The trick to it is for you to understand what is consideration and is that payment being applied against the consideration. So even if, as in the example I made, you made a supply of 100 million, but somebody gives you R1. If that R1 is part of the consideration, then payment has been made. Okay. Now, if we then look at 9.3b,
yes.
All right. So it says where and to the extent that goods are supplied progressively or periodically under any agreement or law which provides for the consideration for that supplied to be paid in installments or periodically or in relation to the progressive or periodic supply of those goods. So here, there are two things that are happening. There are goods being supplied progressively or periodically, and the payment is also being made in installments. So can you see there are two things happening? Whereas
yes.
in the others, in my example, I said you have supplied goods worth 100,000 rands, and that's it. The supply is not periodic. You make a supply right now, 100 million, and somebody pays you R1. Whereas in the 3B Roman numeral 1, somebody is supplying goods on a periodic basis, and the payment is also on a periodic basis.
So it has to meet the two requirements. First, I see like in the case that I'm like, okay, cool, I see installment, but is it progressive?
It has to, so its goods are supplied either progressively or periodically.
One dumb question. What do they mean periodically?
After, let's say we agree that I'm going to send you goods every month. That's a periodic supply for the next, let's say I'll send you goods every month for the next 12 months.
Okay.
So, yeah, so that's a periodic supply. So it's over a period of time.
Oh, now I see it.
Right. So it's either goods are supplied progressively or over a period of time under any agreement or law, which provides for the consideration. So you see, it then says which provides for the consideration. Now we're going to the consideration for that supply to be paid in installments. So goods are supplied progressively or periodically. And the other thing is the payment is made in installments or periodically as well. So if I'm going to give you goods every month, then I then say you must also pay me every month when I'm giving you the goods. So can you see the goods are being supplied periodically and the payment is also being made periodically?
Oh. So if they if they decide to trick us and say that here's the goods, it is a done deal, it's not periodically, it is full blown, they've already delivered, but but you can pay the installment according to the agreement. Will this section still work out?
No, it won't work out because the goods have not been supplied periodically. Yes, the payment is being made with installments periodically, but the goods are not being supplied periodically.
Oh, now I see it. Thank you. Thank you very much.
Okay. So that would then be the distinction. So then what it then says is, in terms of the timing, it then says those goods or services shall be deemed to be successively supplied, and each such successive supply shall be deemed to take place whenever any payment in respect of any supply becomes due or is received, or any invoice relating only to that payment is issued, whichever is the earliest. Okay, so as you can see, they're saying supply is periodic, payment is periodic. Therefore, the timing of the transaction will happen when the supply is due or when that payment is being made according to the agreement of the periodic supply and the periodic payment for that supply of goods or services.
Oh, nah. I was going to make a wrong decision if this came out. So thank you very much. I misunderstood everything.
Okay.
Thank you.
Pleasure. Alrighty. Okay, so if we then continue, so I'm just looking at the time. So if we then continue and we then look at what is then the value of the supply. So if we look at the generic application of that, so it then says, for the purposes of this act, the following provisions of this section shall apply for determining the value of any supply of goods or services. Okay, so section 10 is what we use to determine the value of goods or services. Then subsection 2 then says, the value to be placed on any supply of goods or services shall, save as is otherwise provided in this section. Okay, let me stop there. So it's saying that the value to be placed on the goods will be as follows, but it then says, save as otherwise provided in this section. So what that means, that save as is otherwise provided in this section, is that there might be something else that is contrary to what we're about to say the value of the goods is, which means whatever the thing says, you are going to apply it. But what we are about to give you right now is the general principle around the value of goods for VAT purposes. Okay, so it's the general principle for the determination of value for VAT purposes. However, there could be other sections or subsections that contain specific information about specific transactions, and you then need to use those specific valuation rules when it comes to those types of transactions. Okay, so save as is otherwise provided in this section. Then it will be the amount of the consideration for such supply as determined in accordance with the provisions of subsection 3, less so much of such amount as represents tax. Okay, so the value of supply in easy terms is the value of the consideration. Okay, because it says it will be the amount of the consideration for which supply, as determined in accordance with the provision of subsection 3, less so much of an amount as represents tax. Okay, so what is the value of the consideration? Minus the VAT portion. That is then the value of a supply. Okay, so that's the generic rule when it comes to the value of the supply. But you do realize that it then says as determined in accordance with the provisions of subsection 3. Now, subsection 3 then looks at specific transactions and says this would then be the value of the transaction. Okay, so then if you then read subsection 3, it says, for the purposes of this act, the amount of any consideration referred to in this section shall be, to the extent that such consideration is a consideration in money, the amount of money. So if you are entering into a transaction using cash, that will be the value of the transaction will be that cash value. Then it then says, and to the extent that such consideration is not a consideration in money, the open market value of that consideration. Okay, so if it's not cash and you're not using cash for the transaction, then the value of the supply will then be the open market value of the transaction. Now, something that is quite important here is that that term, open market value, of course, you find it in the VAT legislation. You do not find it in the Income Tax Act. Okay, and because you only find it in the VAT Act, you then go to section 1 of the VAT Act, which then defines for us what is an open market value. It says open market value is defined as in relation to the supply of goods or services, means the open market value thereof determined in accordance with the provisions of section 3. Okay, so in order for us to then determine what is the open market value, we need to look at section 3, which then tells us how we determine open market value. And the heading, of course, of that is determination of open market value. It then says, for the purposes of this section, similar supply means in relation to a supply of goods or services means any other supply of goods or services that in respect of the characteristics, quality, quantity, functional components, materials, and reputation of the first mentioned goods or services is the same as or closely or substantially resembles that supply of goods or services. Okay, then it then says the open market value of a supply shall include any tax charged under section 7(1)(a) of that supply. Right, so then an open market value is the value of goods including VAT that is charged on those goods. Okay, as you can see, the legislation is very specific. It says including, it includes the amount of VAT that is charged on that supply. So if you are in a test and the scenario specifically talks about an open market value, it means that amount is this amount as defined in the legislation as the open market value. And the definition, of course, says it's an amount that is inclusive of VAT. So it's an amount that is inclusive of VAT. Okay. So be on the lookout for that. This is something that you tend to come across in a lot of papers where they talk about the open market value and they also talk about the market value. So whenever you're talking open market value, you need to know that that is a value-added tax concept. Whereas if we're talking market value, then that is income tax. Yeah, so open market value, think of it as VAT, whereas market value, think of it as just normal tax. Okay, Then if we then go back to section 10, now we then look at section 10 subsection 4, it says where a supply is made by a person for no consideration or for a consideration in money, which is less than the open market value of the supply, or the consideration cannot be determined at the time of supply. Okay, so in this case, we are dealing with a transaction that is less than its open market value. So we can't determine consideration, or we've entered into this transaction and it is at a value which is less than the open market value. It then says the supplier and the recipient are connected persons. So when you're looking at section 10 subsection 4, you need to take the entire thing into consideration. So you cannot just say A is applicable and leave it there. No, you need to say A is applicable, B is applicable, C is applicable. Only then, if all three of them are applicable, do you then say this is then going to be the value of the supply. Okay, so in B, we said the supplier and the recipient are connected persons in relation to each other. Now, something else that's important there, it says the supplier of the goods and the recipient are connected persons. Okay, so they are connected persons, and therefore, because they are connected persons, what do you call this? Because they are connected persons, you then need to look at the connected persons definition that then says, what is a connected persons in terms of the VAT legislation? Okay, because remember, there is a definition of connected persons in the VAT legislation. There's also a definition of connected persons in the income tax legislation. So you have to look at the VAT legislation and say, what is the definition of a connected person in terms of the VAT legislation? Because it's got different threshold compared to the Income Tax Act, in order for you to then say these two people are connected persons. Okay, something that we need to be on the lookout for. Okay, so different definitions. Okay, and it's something that tends to confuse a lot of people, because a lot of people look at the connected persons definition and they think, okay, fine, I'm going to use the connected persons definition that is contained in the Income Tax Act. It will be equally applicable in the VAT Act, but it's not the case. In this instance, the VAT Act has got its own definition of who is a connected person for the purposes of the VAT Act. And the Income Tax Act also has got its own definition of who is a connected person with regards to the Income Tax Act. Okay, so if we then look at C then says if a consideration for the supply equal to the open market value of the supply had been paid by the recipient, he would not have been entitled under section 16 subsection 3 to make a deduction of the full amount of tax in respect of that supply. So it's then saying, in addition, the person who is buying these goods, if they will not be able to claim the full input from this transaction. Okay, so it's not just that they can't claim the input. So that if they're entitled to a portion of the input, that means there's a portion of the input that they can't claim, because here it talks about the full amount of tax. So it doesn't talk about a portion, but it talks about a full amount of tax. So if the full amount of tax cannot be claimed, then you are looking at section 10 subsection 4. So then what are the implications then of section 10 subsection 4? It says that the consideration in money for the supply shall be deemed to be the open market value of the supply. Okay, so in simple terms, two people have entered into a transaction. That transaction is not at arm's length. Those two people are connected persons, and the person who's buying the goods will not be able to claim the full input that they were charged. Then section 10 subsection 4 then says the value of that supply will then be equal to the open market value of the supply. Okay, right, any questions there? For section 10 subsection 4 is usually something that is topical, and I know that a lot of candidates tend to struggle with Section 10, subsection 4.
So with regards to the same section, subsection that we add now, the part C that we just read, it's saying would not have been entitled under section 16.3. So is it with specific to that subsection?
Remember, section 16, subsection 3 is the section that allows you to claim input VAT.
Yes.
Yes. So section 16, subsection 3 is the one that says when you are determining the amount of VAT, you are entitled to claim a deduction of any VAT that you've paid to other vendors.
Okay.
Yeah. Then the other one I'm just looking for, which usually sorry, there's one section that I'm looking for that I want to talk to. Okay. I'm not finding the section that I'm looking for. I'm not finding the section that I'm looking for. Okay. But anyway, right. Any other questions maybe before we then move on?
If you could maybe help us with the value of supply with regards to section 18, the change in use.
Sorry, say that again.
The value of supply with regards to the change in use. Section
Okay,
18.
we'll specifically talk change in use.
Yes.
Yeah, I'm saying I'll specifically touch on that.
Okay.
Yeah. Okay. All right. Before I kid you, it is now 11:24. Let's take a break. How about we come back at 11:30? Okay, so let's come back at 11:30. Give you guys a bit of a break, leg stretch, get something to get some water or anything to drink. And then we are all then back at 11:30.